This is the best year that gold has had since 1979. That is not insignificant, but also a key difference between now and 1979. That was the end of the gold bull market. And in 1980, Paul Volcker raised interest rates up to 20%. That's what killed the bull and brought inflation down. But the current Fed is cutting rates, is going to cut rates more in 2025. So gold is just getting started. This is at 1979. This is 1971. So gold is going to rise multiples of its current price. Just like earlier in this century, gold started in 2001, was $270 an ounce, and it had a 10-year rise to $1,900 in 2011. Then it went sideways for about a dozen years, 13 years. Now it just broke out this year, and I think we're going to see a move as big as that earlier move, and that was a six-fold increase in gold over 10 years.
Once gold breaks out against the 60-40 portfolio, and silver makes a new all-time high, the current secular bull market will fully align with the one in the 1970s. The setup is for spectacular gains in precious metals over 3 to 4 years. The potential gains should surpass those seen in the 2000s from periods like 2005 to 2007 and 2008 to 2011. Some research sets the upside for gold prices at levels as high as $3,000 per ounce, which would represent an increase of more than 25% from current levels. Precious metals dealer and independent investment advisor Peter Schiff believes gold's upward momentum is just beginning, with prices nearing $2,700 and up 30% this year. He contrasts today's market with 1980, noting that while high rates ended that bull run, the Fed's current rate cuts will likely push gold even higher. At the start of the month, investors were warned that September has historically been a challenging period for the precious metals market. However, it seems clear that this year's seasonal trend has been broken. Regarding gold's future, Peter predicts it could see a six-fold rise, similar to its climb from 2001 to 2011, potentially reaching $20,000 per ounce. He also forecasts a dollar collapse next year, pushing gold prices further upward. There is a chance that the United States, based on the sudden decision of the U.S. Fed Reserve to introduce interest rate cuts in order to combat inflation, could also face a major dollar crisis in the incoming weeks, as major market factors are pushing the economy into a crisis. While analyzing the market, Peter highlights that the GDP is inflated by borrowed money, not real growth. With gold going up, he predicts it signals deeper economic issues. Now, we present the clips of Peter Schiff's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think we're just getting started. I mean, gold is up almost 30% so far this year, and another, all-time record high today, getting close to 2,700 in the spot market. This is the best year that gold has had since 1979. That is not insignificant, but also a key difference between now and 1979. That was the end of the gold bull market. And in 1980, Paul Volcker raised interest rates up to 20%. That's what killed the bull and brought inflation down. But the current Fed is cutting rates, is going to cut rates more in 2025. So gold is just getting started. This is at 1979. This is 1971. So gold is going to rise multiples of its current price. Just like earlier in this century, gold started in 2001, was $270 an ounce, and it had a 10-year rise to $1,900 in 2011. Then it went sideways for about a dozen years, 13 years. Now it just broke out this year, and I think we're going to see a move as big as that earlier move, and that was a six-fold increase in gold over 10 years. If gold goes up six-fold from here, that's close to $20,000 an ounce. It's not that gold is getting more expensive. When we first started our country in 1789, gold was $20 an ounce, and it was still $20 an ounce in 1913, over 120 years later, when we established the Federal Reserve. But now you can't buy an ounce of gold for $20. You need almost $2,700. It's the same ounce of gold. All that's changed is the value of the dollars that the Federal Reserve creates. Well, the dollar is about to collapse. In fact, it's almost near a new 52-week low here again today. If you look at the dollar index, it's near a 13-year low against the Swiss franc. It's going to hit a record low against the Swiss franc next year. But I think next year the bottom is going to fall out of the dollar, and that's going to really unleash a bigger move up in the price of gold. But again, it's not gold becoming more valuable. It's the dollars that they're printing becoming less valuable. The GDP is consumers spending borrowed money to buy more expensive groceries and stuff like that. It's the government spending borrowed money is a big part of that GDP. And we have a massive deficit that is a consequence of this fake GDP growth. In the meantime, our current account deficits are at record highs. Our trade deficits are at record highs. The economy is hemorrhaging red ink. We do not have a good economy. We don't have a growing economy. We have inflation. And inflation creates the illusion of economic growth. But people are getting poorer, even though the numbers are going up. Again, look at the price of gold. You need almost $2,700 to buy 1 ounce of gold.
Right.
In his assessment, Peter Schiff suggests that the Federal Reserve's early rate cuts reflect growing desperation, especially with gold hitting record highs. He anticipates inflation will spike again, driven by rising oil prices, pushing it beyond 9% in 2025. According to the CME FedWatch tool, market analysts are increasingly factoring in a 51% chance of another 50 basis point rate cut in November. Although gold pulled back from its peak, the precious metal is poised for weekly gains, supported by growing expectations of further U.S. interest rate cuts. The Federal Reserve's recent decision to lower rates by an aggressive 0.5% helped fuel a surge in gold, which has gained 1.8% so far this week. Anticipation for another cut later this year continues to provide strong tailwinds. According to him, the national debt is rising unsustainably, with interest payments now exceeding $1 trillion annually. He predicts that rising Treasury yields will force the Fed to resume quantitative easing by early next year. Let's get back to the interview.
The Fed is very desperate. I mean, normally they wait until there's a problem before cutting rates. They wait for, major stock market decline. They wait for a recession. But here, they're cutting rates even before we're officially in a recession, and with the stock market at all-time record highs, with real estate prices at all-time record highs, and with the gold price at an all-time record highs. We've never had the Fed start cutting rates when gold was at an all-time record high. And in fact, the record high in gold proves that the Fed's rate cut was a mistake. It proves that the Fed is too loose. In fact, they never achieved a restrictive policy. They keep talking about that, but they never really got restrictive because credit kept expanding. We have record amounts of debt, government debt, corporate debt, household debt, credit card debt. Nobody stopped borrowing, and we have record low savings. So that shows that the Fed never raised interest rates high enough to break inflation, and now they're cutting them prematurely. And so gold is telling you that we're going to see a spike in the CPI big time, I think, in 2025. We've seen the lows in inflation. 3% is about as low as it's going. Now it's heading back up to 9% and then higher. And I think one of the big drivers next year is going to be oil, because right now oil is the lowest it's ever been in history. You can buy 40 barrels of oil with 1 ounce of gold. Outside of like a few weeks during COVID, that's never happened. So oil is super cheap right now, but it's not going to stay cheap. It's going to, after the election next year, oil is going to go up, commodities are going to boom, and the Fed is going to be in a real box along with the economy, because inflation is going to be breaking out at the same time the economy is breaking down. So we're going to go into a recession with rising unemployment, but we're also going to have accelerating inflation. And so what's the Fed going to do in that circumstance? If you look at the way the national debt is rising right now, it's rising about $3 to $4 trillion every year. Interest on the national debt is over $1 trillion a year. It's now more expensive than defense. In a couple of years, we're going to be paying $2 trillion a year in interest on the debt. It's going to be a bigger expense than Medicare or Social Security. Fiscal policy of the United States is rapidly breaking down. People are losing confidence in the dollar. They're losing confidence in the creditworthiness of the United States, our ability to service this debt. We have no ability to repay it. And so the dollar is going to be marked down, and I think the world is going to be divesting of treasuries. That's why you're already seeing yields on the 10-year to the 30-year are higher now slightly than they were when the Fed started cutting rates. And I think that's going to continue. In fact, I think that by the first quarter of next year, and maybe even before the end of this year, the Fed is going to return to quantitative easing, because the yield on the 10-year Treasury is going to break above 4% again and head higher. And I think the Fed is going to panic at that point and relaunch quantitative easing.
Advocates of investing in gold call it a safe haven, arguing that the commodity can diversify and balance your investment portfolio and mitigate possible risks down the road. Do you think rising debt and inflation will continue to push gold prices to new all-time highs? Or are there other factors at play that could change this trajectory? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.